Hey guys, welcome to episode 2 of the Onvisor podcast. My guest this week is Joline Cloutier. Joline and her husband Pat have been mortgage brokers with Centum Home Lenders here in Moncton, New Brunswick for a very long time. They have a lot of experiences helping people purchase their first home, refinancing their home, helping them with their debt solutions, as well as helping them finance real estate investments, etc. So Joline also has the Money Buddha podcast. So we had a lot to discuss. We cover a broad range of financial topics, not only debt and financing, but we talk about budgeting, people's habits with money, and much, much more. So I hope you guys will enjoy this episode as much as we did. Enjoy making it. Quick note, there might be a black screen for a period of the video recording of this. That's just a technical error. Stay with us. The video does come back. The audio remains unbroken. So anyways, stay tuned for episode 2 of the Onvisor podcast. Hey guys, welcome to episode 2 of the Onvisor podcast. Today's guest is none other than Joline Cloutier. I've known Joline for a number of years. She is a mortgage professional with Centum here in Moncton. So she works with clients of all kinds, helping them finance their dreams, real estate, etc. So I'm super excited to have her on. She has her own podcast called The Money Buddha. So we have a lot in common. So I'm very excited to welcome Joline to the studio. So Joline, how are we doing today?
Hi, Marcel. I'm doing so good.
Awesome.
I'm really excited.
Yeah, we're going to jump into all things debt, really. Debt management, etc. But to get us started, how about you start things off with explaining a little bit about Centum Home Lenders, how you got started in the industry, and we'll start there.
Cool. Okay, so I started really young, actually, as a mortgage broker. So in 2008, my husband was already a mortgage broker. So straight out of college, that was his first job placement, actually. So 2007. And then I graduated the year after and started working. I was in marketing.
Okay.
But I was kind of seeing him on the sidelines, doing being a mortgage broker, all that. And I was like, I could do that. So he got really busy in 2008 when the rates all dropped, when the crash happened. Right. So he was like, oh, do you want to help me out on the side? You know what I mean? After your day job, call some clients, all that stuff. Because they had leads come in, right? So there's a lot of people that call. So he saw the opportunity. So I was like, yeah, for sure I can do that, right? So I already had thought about it.
Yeah.
I could do that.
It
so
was in the
yeah,
realm of
sure.
possibility.
Yeah. So I was like, yeah, I'll do it. So and I like people, so I was talking to them on the phone, mostly taking their information, and then he would do the background stuff with the banks and stuff. And then back then there wasn't any licensing for mortgage brokers, so it wasn't anything complicated, right? So so that's how I started, basically, just doing that. And then eventually I got too busy, so I was like, I kind of need to decide. So went full-time in there in 2009. Okay. But yeah, so almost out of college, it's been almost my whole career has been a mortgage broker.
Okay. And so maybe talk to us a little bit about what it is you do, how you help people. So what is your, or Centum, or a mortgage broker in general, what is their role when it comes to financing people's projects, their dreams, their own home, their real estate project, etc.? So where does a mortgage broker kind of step in?
Cool. So a mortgage broker, you can really use them. I mean, some people ask that question, what's the difference between a bank and a mortgage broker? in general, I feel like service level for us is what we pride ourselves on. And we're also very like specialized in mortgages because that's all we do.
Right.
So depending on which bank too, sometimes they do like a whole bunch of different things like
savings accounts,
right,
investments.
So open accounts, whatever, right? So I feel like all we do all day long is mortgages. So we get to know all of the different like ways and strategies. We also have access to a lot of different lenders, which is also different, I guess, than just like going to one bank. They might have like one product for a or a few product for a mortgage. So we have like a whole range of products depending on what your needs are. I think a lot of people still kind of have that old like stigma that mortgage brokers are for people that don't have good credit.
Oh, yeah.
Because that's kind of maybe where it started. I'm not sure. Like years ago, that's when people would go see a mortgage broker.
Old myth.
But I think so, yeah. So no, like we really have like we do have access to like top rates. Do you know what I mean the best rates or competitive to like what's out there like for A lenders. Sometimes we might be able to get better. It depends. I guess it's not always like about rates. It's very much about the situation, the product, what your goals are too. I find like that conversation it might be different for a client that wants to buy a house and maybe sell in 2 years versus someone that it's for their forever home. So like
totally.
The advice I'm going to give is going to be different depending on what your goals are. So really it's it's a whole
product
big
fit.
World.
Product fit's a big part of your world. And, you know, as a broker on the insurance side, it's good to know and get familiar with your product lineup and the fit. And another myth, too, that I've experienced is that, you know, a lot of people think that brokers don't pair you with banks sometimes.
Right.
That like it is decidedly the non-bank option. When in reality, a mortgage broker could very well put you with a TD Bank or a Scotia or whatever, particularly if you even like ask for it, you know. So not only do you guys have the advantage of knowing what else is out there, but if somebody likes working with their bank or likes the idea of a brick and mortar place that they can go get service, which has been my choice usually with my lending, is I like being able to walk into and speak to a branch manager or something to deal with the issue. Not that my broker has never like been there to help me with that, but I just find it's a popular misconception that it's a bank or a broker.
Right. Yeah. So you said it. So we do have access to TD Scotia, BMO, like we have other ones. So it's, depending on what someone's going to tell me, if they're like, oh, well, I prefer that because I already have accounts there. Sometimes too, it also might help like a file that isn't like, that's kind of borderline. If they already have accounts, do you know what I mean, with TD, let's say, well, like maybe they're going to prove it better than like someone else that doesn't have a relationship already with them.
That's
that's all like things that we look at to decide where the best fit would be for the client. I know for sure it's not an all or nothing. And another thing I find, I always, if I think you're already in a good spot with your bank, if you call me for your renewal, let's say, and like you don't want to pay off some debt, you just want to keep going, they're offering you great rates, like I'm going to tell you they're great rates, just sign
this is the
whichever
best
one you want. They're already offering you the best. Like I'm not going to pretend that I can do magic and do something better. I can definitely offer like service level, but if someone's really happy with their bank, like I'll tell them like you're seems like everything's going well,
nothing wrong
here, you're fine, you can keep going, and now you're just more confident knowing because I did check for you like options and I'm confirming like you're good. So
okay. Interesting. So I kind of want to jump into, because a lot of people ask me this, like what is the home buying process? Like what can somebody expect when they're buying their first home or a home in general, right?
Oh my gosh.
Maybe walk us through that.
Okay, cool. So I really love I think my favorite clients are first-time home buyers for sure. So I like taking someone through the steps and making sure like everything's taken care of and like they're confident and like because it's a big purchase.
Yeah.
A lot of things going on. So generally, if someone wants to buy a house, let's say, they reach out to us. Whichever way there's a whole bunch of way that people reach out. So obviously call or send messages on our Facebook page or website, like whatever, wherever they come to us, we send them the link to apply. So that way they book a call like with us. And so they schedule it, it goes in our schedule and then they fill out the information and then it sends them a link, with the documents that you need. So
Right.
surprise, when you're buying a house, you need to send us some documents.
Yeah.
So some people are surprised by that, but, so we do need to see like income stuff and all that. So one thing I'll say is, when someone's looking for pre-approval, which is probably actually the first step before you go out shopping for houses.
Before you go see the realtor.
Before you go see the realtor, find out how much you can be approved for. Can you be approved? How much, and like all of the details you need to know. Do you have enough for your down payment? Like
How much
closing
house can I
costs?
get?
Yeah. And like, are you comfortable with that number? We don't put all your expenses in there. We don't put daycare. We don't put groceries, right? Like in your application. So like, I'll tell you what the numbers show me. But this is like the monthly payment. Like, is that like in your budget as well?
Yeah.
So I
Can
like
you
to
work
have
with
that.
this?
Yeah. I like to have that conversation. Is this realistic for you?
Yep. Yeah.
So like, I think that's the first big, like realization for some people, either good or bad. Like, oh, okay. Like, okay, either I'm not ready or my credit isn't where it needs to be. Like that's kind of where we do the coaching or confirm like everything's good.
Guidance.
Yeah, like what the next step is. So
Okay.
someone applies, either they're good to go, we give them a pre-approval, or if we're like refinancing, we'll keep going. But someone that's buying a house, it's either pre-approval or okay, you need to do something like credit issues or work on down payment, or the ratios are too high. Generally, a lot of people, if they have debt when they're buying, I get that question actually. Like sometimes people think they can't buy a house if they have debt, and I'm like, no, that's not how it works. You can have them. It's just, does it fit in the ratios? So your income versus
And we're talking about debt service ratio here, right? To be specific. So do you want to explain what a debt service ratio is? Just so people can kind of wrap their heads around it?
Yes. So generally, when you're buying a house, the ratios that the banks are going to use, a debt ratio, is there's GDS and TDS. So TDS is the total with like your new mortgage and all of the debt that you have. GDS is just with your debt. So there's two amounts. Like GDS, it has to be under 30, depending on if it's like a CMHC mortgage. There's so many little things, but it doesn't have to be complicated. So we take care of that stuff. So generally, it's under like 39%. GDS, so that's just your debt without the new mortgage, and then 44%, so it has to be under 44%, so your income minus all of the debt that you have. Like,
so it's to make sure that you're not taking on debt you won't be able to pay, including the debt you already have, which could be your car or whatever else, maybe student loans, whatever. So when you add them all up, there's there needs to be you can't put 125% of your income towards debt. It's not going to work. So basically for you guys, it's a very popular tool to say like, this is going to work or not work, or this mortgage is too big. You need to look at a smaller house because the payment of the bigger debt is tipping the scale of the acceptable debt servicing.
Right.
So you guys work with that on a daily basis, basically, right?
Yes.
Okay.
The thing I'll say to that makes the biggest difference that I see is car payments. So most people will have like biweekly car payments, and it doesn't seem like a lot. Oh, it's only like $320 biweekly. It doesn't sound like a lot, but like $320 times 26 divided by 12, it's like, I don't know, 700 and something, like 800. So it's not times two, it's actually more.
Yeah.
And so it's like someone that's trying to buy a house on their own, and they make, I don't know, just generally like, I don't know, $50,000. Like if you have a car payment, like you probably don't have anything left to qualify.
Yeah, exactly.
To purchase right now
Because
in
you
Moncton,
can't
right?
car plus mortgage can't equal 100.
No,
You need to eat.
It takes up basically most of what your mortgage amount could have been, like your monthly mortgage payment. But it's already there. It's already taken for. So like what's left.
Yeah.
So yeah, it's like, and sometimes people will ask us that question, like, oh, how much? They'll send an email or something. How much income do I need to buy a house? And it's like, whew, like it's not.
It's too too wide
I
of a
have
question.
too many questions for you.
Yeah.
Like you can't answer that because there's no straight. It's very much like all the pieces of a big puzzle
that's
together.
right.
Yeah.
There's a lot of moving parts here.
Yeah.
Yeah. So, okay, we have our pre-approval. We figured out how much house we can buy. We find the house, make an offer on the house. Again, realtor takes care of all of that. Thank you to all the great realtors out there. And then what? What usually happens after kind of everything is greenlit and you're moving forward? Like, obviously, there's the, closing dates and everything. So how does that kind of shake out as well?
That's a good question. So there's a lot that goes between accepted offer and closing date on our end.
For sure.
So the background stuff. So I think a lot of people don't know this, I guess, right? So
I don't even know this.
Right. Okay. Good question.
I mean, I've worked at a bank. So
yeah,
a little bit, but.
So basically, as soon as someone finds a house, so we give them their pre-approval, they go shopping for their house, find a realtor, shop for it, accepted offer. As soon as we get it, that's when we do your pre-approval, but then that's when we get back into the game for you because sometimes it can take months, before they find a house so then it's like, okay, we get your pre-approval, cool, now we can run with it. So we send that to the bank like with your full application, so we make sure everything's good, and then that's when we send all of the documentation
that you've already received.
That we might have received.
Right. Okay. Ideally, have received.
Ideally, we already have your income stuff, but then that's when it's like, okay, we need 3 months bank statement for it to show to confirm your down payment.
Where it's coming
from, or your RSP statements, whatever. That's when like very much the details come out. And then we also need like, I don't know, like if someone has CCB income, like then we have to see like those documents. So it really depends on what type of transaction it is. So like, is someone full-time, like permanent, just
self-employed,
base, or is it self-employed? If it's self-employed, we're going to ask you for a whole bunch of other stuff more than what we probably just had for your kind of your income for the pre-approval. So that's when all of the fun stuff starts. So I find a lot of people at that point, they'll be like, I thought I was approved. And it's like, you're approved. And now we have to fulfill all the conditions in that list on your approval to close.
Yeah, it's like I've looked at the checklist. Now it's time to check off the checklist.
Yes,
it's
exactly.
Like speed 1 versus speed 2. Commitment 1, commitment 2.
Yeah. So people are always surprised. And even like realtors.
I thought I was good. Well, you were.
Yes. And so usually they have an accepted offer, and then you have a condition financing date. Like that's on your contract. Your realtor puts that in there, usually maybe a week or two.
Right.
So
where you need to prove that you can get through this
that
hoop,
it's really going to go through.
Yeah.
So I find that's kind of where people get it. Like I thought they were approved, or because even realtors will ask us that.
Yeah,
like,
of course.
Why can't you send me the finance letter?
Yeah. Certainly new realtors probably.
What's
sometimes.
that?
Certainly
Maybe,
new realtors sometimes. Yeah.
So I try to like educate people on it. So it's almost like when you have an accepted offer, but you have to do water tests and you have to do an inspection and give the deposit. Like all of us is get the financing. So like if someone has an accepted offer, like it's not for sure gonna like close, right? Like it's not a firm, you don't put the sold sign before you do all these
conditions. Yeah, for sure.
So we do the same thing for the financing side in the background. That's when we ask clients like, okay, we need this. Oh, the bank asked for this. Why is your name different on your pay stub? Like it's questions, like it's just their underwriting. They're looking at everything very carefully.
Right.
Pre-approvals, like we underwritten it like for us, for the clients to make sure that there shouldn't be any surprises or anything that we can think of, is looked at. But then once they open the file, the bank or the lender, that's when things can come up. Why
Yeah.
is the year to date on their pay stub less than what
Yeah.
it says that they make on their letter? Like all of the things. So that's why we try to get all the documents for the pre-approval the most
Yeah.
possible. But then there's always something. There are always things to.
You're basically, an easy way to put it, if I'm hearing you correctly, is like you're almost putting a package together for an underwriter. So
Yeah.
you're doing all of your due diligence and saying, like, I know they're going to ask for A, B, C, and D. If you don't have them, like, it's almost no point sending it to the underwriting, like, and the underwriter being the person who basically signs off on the bank on all the amounts. So you're kind of like creating packages so that process goes smoothly. You're like kind of like an in-between
Yes.
the client
very much.
and then the underwriter for the bank, right?
Yes.
Interesting.
Yeah.
Cool. So, and then, you check off all the boxes, goes back to the realtor, all systems go, green light. Talk to us a little bit about the closing, because usually there's going to be a period between the offer, the accepted, and usually the people who are moving out. If it's not an empty house, there's like, maybe it's in 6 months, the closing date, or so usually there's a period of time where it's like, yeah, I've checked off all the boxes. Nothing's changed in my personal circumstances, etc. But then comes what I call crunch time for you guys and lawyers alike and realtors as well. This is where I don't envy your profession. But tell us about closings and how that kind of goes.
Okay, good question. So generally that period of time, depending on how quick or not the closing date is from like the initial accepted offer, sometimes if it's a longer, like 3-4 months period, which usually it's closer, but sometimes it happens. I find clients, because it was so much that back and forth at the beginning to kind of get to the financing letter stage to give to the realtor by the certain date, then it's like sometimes it's kind of like we don't have to like communicate with them that much, and they're like, am I forgetting anything? Like,
Right.
what else am I supposed to be doing? Something, because they did so much for us, for the realtor, for like insurance, like all of this at the same time at the beginning.
Yeah, to get it off the ground.
Right.
Yeah.
And then at the end, so near closing date, usually you might go sign like the week of with your lawyer. So by that time, we already asked you who you want to use for your lawyer, all that stuff.
Yeah.
Generally, it's just to make sure, like, one is you're going to have to bring your down payment and closing costs to the lawyer.
Yeah,
like,
the difference.
Yes.
Yeah.
So minus your deposit that you
Minus the
already
deposit.
made.
Yeah.
So, and usually a lot of like first time home buyers, they'll call me in a panic like a few weeks before closing, like, do I need to, is it minus my deposit, or am I like missing money? Like a lot of times that happens.
Where'd
they
that
like
10 grand go?
yeah. They're like, am I missing money? It's like, no, you already gave your deposit. That's why. So they'll basically at that point, once we like, they call it broker complete. So if we complete our file, which has to happen so that the lawyer can do their job.
Yeah.
The lawyer received the instructions from the lender, whoever the bank is you're with. So they received their instructions, which is basically the same as what we just did on their end. So they
Another
have
checklist.
condition. Yeah. So they have a checklist of things to do. They might ask for certain things from the client. So it's kind of like start again, like another little like marathon of like, oh, like need to send stuff.
Yeah. Right before moving.
Yeah, exactly. And then booking, like, I don't know, is U-Hauls or whatever. So generally, usually it goes well. In general, things go well. It's just sometimes things can happen, like last minute, the bank forgot to ask for a T4. Like it's happened like on our
slipped.
So they kind of look at it again sometimes, and you're like, oh, like they come back to you like a few days before. It doesn't look good on us. Surprise, yeah. And then we have to call surprise like clients, and it's like, oh, I thought everything was done. But it's like, yeah, it's just things happen, whatever. We just have to be quick, and like that's our job, like to just figure it out.
And then the lawyer basically carries it across the finish line.
Yes. So one of the biggest things I'll say, I guess, that people might not know for like closing costs. So like you're putting your down payment, which is minimum 5% down to purchase in Canada or whatever, New Brunswick. And then you also have your closing costs. And closing costs can like really like go up quickly. So I say closing costs between 2 to 3% of the purchase price is a good number.
That's nice to know.
Yeah, so that's kind of the range. So in New Brunswick, it's 1% right off the bat of your purchase price
transfer
for
tax.
land transfer tax.
Gross.
So if it's 500 grand, like if you're buying for $500,000, if that's how much your house is like purchase price, it's $5,000 right there.
Just in tax.
One thing,
to change the deed, pretty much.
Yeah, exactly. It's just to the government, and then you pay your lawyer, obviously. But the lawyer isn't what's expensive.
No,
it's not their fee to do the paperwork.
But they collect it.
Yeah, well, because they work so to get you to the finish line. But so their fee isn't like the big chunk.
No.
It's really everything else that adds up. So closing costs. So it's just like land transfer tax, property taxes. If you're buying in June, you have to reimburse basically the seller from June to December.
Big one,
yeah. So depending on when you buy during the year.
Yeah, that's right. It can be a lot.
But that's another chunk, like right there. So and then there's little things like disbursements, whatever, just other things that add up. Like, so that usually I say 2 to 3% more than the down payment.
And then you get the keys and you're good.
Yeah, whew, and then you try to relax after all that, the marathon.
Well, that's thanks for sharing all that. That's a lot of it's a big process buying, especially your first time around, your first home. It's a big process, and your lender is a huge part of that experience. So I appreciate you sharing that, and hopefully people can learn from that. One thing that I found very interesting too when I bought my first house was how you can there's always tricks along the way. Like the property taxing, I don't know if it's still like that, but basically if you go on EPP, equalized payments, you can actually kind of get back some of your initial lump sum. So again, don't quote me on this, but I know that, there are ways sometimes that, you can ask a lot of questions because your broker, your lender, your realtor, and for me, the brokers that I've worked with always helped me tremendously in, I don't want to say it's not cutting corners, but it's basically being effective and knowing the little things like energy audits on your new home and getting that rebate. Like that can pay for your property tax lump sum. Like, so those things are, a broker and somebody who's been around for a while can really help out with all that stuff. Anything that pops in mind that people usually forget for you?
What you said for the equalized, no, it's right. So for your property taxes, so the biggest difference, so what you're talking about is that if someone has their property taxes, if they already bought their house, when you pay property taxes into your mortgage, you're paying with your payments
alongside the mortgage. Yes.
Yeah. So you don't pay any interest on it. It's just they take it out, put it in a separate. They obviously probably invest it themselves, but
why wouldn't they?
But a lot of banks are actually going away from it because it's too much work, maybe. But
a lot of admin, yeah.
Probably. So anyways, people can pay their property taxes with their mortgage if the bank allows it. Yeah. They put it aside, but it's for next year's property taxes. Yeah. So if you're buying this year, you already paid for this year's taxes at closing. Or you're
reimbursing them because they did. The seller already did.
Exactly.
So you got to reimburse the difference. So it's all prorated.
Yeah. So you already paid for this year when you're buying, but you're collecting for next year.
That's right.
So if so the bank makes sure there's enough. If not, they'll adjust it, blah, blah, blah. Yeah. But then there's also Service New Brunswick that you can pay equalized payments. It's only once a year, I think, when your tax bill comes out until it's due.
It's an opt-in, right?
That you can register for it. Yeah. So it's like right now till like May, I think.
Yeah.
Don't quote me on that, but it says on your bill.
And only for your own residence.
Yes.
Your principal residence.
Yeah. I believe so.
I'm pretty sure, yeah.
So if someone does it with Service New Brunswick that way, that one is for this year.
Right.
So that you're paying, they're going to take, if you start right now, it's April, they're going to divide in how many months left. And then the next year it's like per month, right? Yeah. So that's the, not trick, but that's where some people found the loophole of like, okay, my taxes, if I cancel with my bank and they allow it, sometimes they don't if it's a certain type of product like CMHC insured or whatever. So you can check with your bank and call them and be like, hey, make sure you can opt in your
EPP,
the Service New Brunswick one. If you register for that, cancel the one with your bank.
Yeah.
They can send you the money that they have in the account, in
That's
the
right.
tax account. But that one's for next year, and you're
Yeah.
paying. So it's like you get that money back
Yeah.
that one time when you do that switch.
Yeah.
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 So people can
Well,
do that.
and what I was referring to, and again, I'm not sure if this still works, but this is from memory and this is several years ago. But I thought because it's for this year, and that's where the hook came in, because it's for this year. If you've already paid this year, you can go and ask the province for what you've prepaid back, telling them that they're gonna get it back in their payment. So you can actually I think in the past I've received my lump sum back, and I just kind of give it back in installments. Don't quote me on this. I may be wrong, but that was a pleasant surprise to know that I could tap into that. But it's all a timing game.
Yeah.
It's not necessarily something that I'm promoting or advocating for, but it's nice to just have those conversations, learn, and ask questions. My whole point here is ask questions, because sometimes, things work out in your favor when you do ask questions.
That's true.
So what would be the most common mistakes you would say you see with people when it comes to managing debt or even managing their finances in general? So you specialize in debt. You have in-depth conversations with people about their money. You know how they're spending it, what they're doing with it, because you basically assess it in order to put that package together. So what would you say are the kind of the main mistakes or pitfalls that people fall into? And maybe after that we'll talk into how we can improve on those, or what are some tips and tricks.
Okay, so a few things that popped in. So I feel like a lot of people either one is that they don't really look at their spending, which then creates overspending, right? There's no budget, so it just like it's easy to creep in, like if you have a line of credit, a credit card, like, and just kind of go through life tapping so it's easy to not look and just like, ooh, like kind of once you do look, you're like, oh shit, like it's further than I thought, or like I don't know how we got here, like all
why
that
is my
stuff.
line of credit going up
why is it so
or
high
every 6 months? Why does it keep going up? I don't know.
So life happens. Life is so quick, right? Everything's so quick. It's just so fast, and I find like you don't have time to like keep up with the spending that happens. Even just like buying groceries, like the stuff for your kids, like just living like the basic stuff.
Yeah.
Keeping everything like just your household like
staying afloat.
Yeah, basically like at home, that's me. I'm the like CEO of like making sure we have enough shampoo and whatever and toilet paper and food, and like so like I'm always restocking, right? So that's like, anyway, so I get it.
Yeah.
So I find that happens, which then creates the debt because they're just not looking.
Yeah.
And then I find a lot of people wait too long to reach out. So someone that, because that's easily refinanceable if you own a house.
Yeah,
you
can
have
tap
equity.
into the equity. Yeah.
Yeah. And so I find that something that people, they'll like be embarrassed, or they just don't want to know or look, and they just wait too long.
They don't want to face it.
Yeah, they don't want to face it. They're not ready for it, and I get it. I find when I talk to them finally about it, they're so relieved. Even if it's like, oh shit, this is how much debt we have. Like I find people are I just talk to them on the phone, and from the start they're like, oh, I don't know how this happened, all that stuff. And then at the end they're like, oh my gosh, like, okay, like there's a plan. They know where they're at, what the payment's going to be if we do it, what's possible, all their options. And they're like, oh my God. So I find when people wait too long though to look at it like that, to reach out, to seek help in what the options are, then sometimes if they get too high on their balances are close to the limit, their scores go down, like credit score. Yeah, so that's the biggest thing that I see.
Yeah, and let's touch on that a little bit. So you said your score. So here we're talking about credit scores, right? So in the first module of the Plan Your Finances program, I do talk about that a little bit, of what affects your score. And I talk about revolving credit versus fixed credit. And for those who don't know, revolving credit's kind of like a credit card or a line of credit. You can pay it off to zero if you get a bonus, but you can turn around and buy a boat the next day. So it's revolving, like a revolving door. So it's the more dangerous of the kinds of debt. So it's the one that's a little bit more under scrutiny, as opposed to like a mortgage or a loan. It's a fixed payment structure. It's over a 25-year mortgage or a 6-year car loan, and as long as you make your payments, kind of like a cell phone, is just recorded as a successful payment, right? But with revolving credit, there's like a catch, a balance amount that actually either improves or reduces your credit score. Can you dive into that a little bit?
Yeah. So generally, they say under 30% of your limit. So let's say you have a credit card for 10,000. Then if you're under 3,000 and under, then your score is going to be like
Carrying
excellent.
a balance.
Yeah,
like
carrying a balance.
An ongoing
so if your
balance.
balance is 3,000 or less, your
Yeah.
score is going to stay really good.
You can spend the 10,000 and pay it off at when the bill's due, and that's all good.
Right.
That's positive.
But if it always stays at 10 or
Yeah.
at 9 or at 8, like 8's not as bad, I guess, but if it's 9, it's probably going to bring down your score.
Yeah.
And then everything revolves, like, sometimes people will be like, oh, well, I was able to buy a car like yesterday. And it's like, yeah, cool. But like the car dealerships don't, this credit scores aren't the same
the criteria.
criteria as mortgages. Mortgages are very like, criterias are pretty high. So basically, that's the biggest thing is really to keep it. I say 50% to people because I find 30, it's fine. I see people's credit bureaus all the time, and it's usually fine if you're like half.
Right.
But it's just when everything's really close to all of the limits. If you have 3 credit cards or 1 line of credit, 2 credit cards, and they're all really near limit, then your score is going to linger down.
Yeah.
As soon as someone pays it down
To 0 or whatever.
to even like half,
Yeah.
the score goes up almost like the next month if you've never missed payments and everything else is good. So it's very easy to like get it up there. And that's another thing that sometimes we'll talk to them about strategies. Like, okay, it doesn't work right now because of this, only this. Everything else is perfect. So like, can you, do you know what I mean?
Figure this out.
Yeah, like find money to put on these cards and just bring them down. Then we refinance your mortgage and we pay everything back off. Like it's just a step-by-step thing sometimes.
Yeah. One thing, so we're talking about refinancing and equity in the home. I find it's a magical thing for a lot of people. It gets a lot of people that breathing room that they need. The unfortunate downside to that, it is a double-edged sword, because if you keep using your home as an ATM, a personal ATM machine, and you don't address the underlying overspending, as good as you are at your job and as much as you're not only, you're dependent on the home of the value going up forever and ever, which generally it does, but not always at the same rate. At some point, it's the equity that you were hoping for retirement, or the whole reason you bought the home kind of goes out the window, because you're just getting as much debt as the debt is just following you. So it's very important to address the underlying issues, which is the budget. Like I often talk to people, there's kind of several versions of a budget, and people typically have their head in the sand because they don't want to face it, like you said. But also a lot of people think they have this, I call it the back of the napkin budget, which is all their fixed expenses. My mortgage is this, my car payment's this, my cell phone is this, whatever. And they're like, well, then I don't know where the rest is going because I know how much my paycheck is. But that's pretty much the equivalent of like a kid trying to hold water in the beach and they don't know why it's seeping out of the bottom. It's like, well, you're not actually looking at everything. You're just trying to squeeze your fingers harder. It's not going to stop the water from going through, right?
That's true.
So doing a real budget and looking at things a lot, more honestly goes a long way. And, I actually do have a free budgeting tool on my website, which I strongly encourage. It walks you through how to do a budget. And the big misconception about budgets is that they're going to take something away from you, something that we like, right? And that's not always the case. I think you can always do your budget in a way that suits you and your needs. Any thoughts on that?
Yes. So I feel like people are definitely scared to look at their numbers and budget, like to put it all together. And so I find that it relieves your stress knowing, like, and it's just like clear when you actually look at it. It's like, oh my gosh, like, okay, this is where it's going. And then you can make decisions. Like I feel like then you have control over what you want to do next. Like,
Yeah.
okay, do I need to spend on, do you know what I mean, all of these subscriptions? Like, what am I not really using? Like, do you know what I mean, you can cut out some stuff that you don't really need pretty quickly.
Yeah.
Once you're like taking control and being like, okay, like I don't, is this even important? Like, or do we use our side by side? Like, let's sell that.
Yeah,
You know what I mean? Like,
exactly.
oh, like it's paid off. Like we can quickly make blah, like whatever, how much, right? So it's all things that I find when you start looking at it, you get these ideas and then you kind of get excited. Like it's almost like someone that starts selling shit on Marketplace, but like stuff that actually is worth something.
It's a second win. Like,
it's like, and then you get in the mood of like, okay, like what else can I sell? Like made $200 with whatever. Do you know what I mean? Like when it's actual, like not $5 things, but I don't know. It kind of builds momentum towards like actively making decisions for yourself.
Yeah. I think I kind of say I said there's different versions of a budget. There's the back of the napkin one that is worth nothing. Basically, it's worthless, but it's the one most commonly used. It's in my mind and I know what my budget is, but step one, you need to put it on paper. So, and then the next version is what I call informational budgeting, which means I actually went back a couple months, looked at what I actually spend on groceries, what I actually spend on home products, what I actually spend on haircuts, what I actually spend on massages, travel, whatever. So I call that an informational budget, which is essentially your actual information. And then that's where all the aha moments usually come, because you're like, oh, shoot, I didn't know about this, or there's no way I would have never thought I spent that much on that. And then you can shift gears in what I call intentional budgeting. Intentional budgeting is kind of what you were talking about, is what's aligned with my values and how I want to spend my time and money. Is, traveling more important than ordering skip the dishes? If yes, realign your spending with that, right? Do we use our side-by-side? Do I want to travel more than go on side-by-side because the neighbors have a side-by-side? Then make your adjustments, So yeah, good point. I think budgeting is it's the foundation to all financial planning, and it's also a key element in, staying on top of your debt issues. Okay. So let's just shift gears. There's a lot of people looking to get into real estate as part of their retirement plan, their personal net worth, to grow themselves. You and Pat, Pat particularly, I believe, has spent some number of years of growing a portfolio. So I'm just curious, what advice do you have? How can people get into, not only their first home, we've covered that, but, what's kind of the 1-2 steps of how do people kind of get started in real estate? What are the first couple things they should consider? Like
investments?
As an investment, really.
That's a good question. So for someone that wants to get into rentals, let's say, so some people, if they know early enough, I see these ones a lot where it's like, I'm going to buy a house or like a triplex as my first house. Mm-hmm. So that one I find gets people in there quicker because you can buy it because you're going to live there. It's only 5% down. So you can easily get into your first like rental property if it's going to be owner occupied with less money down. Because if you're buying just a rental, even if you have a house and you want to buy another house as a rental, it's going to be 20% down if it's a rental property and you're not going to live there.
And that's because the reinsurers, CMHC, etc. A lot of people don't know this, but when you buy a home, the reason you're able to put only 20% down is because there's actually reinsurers or insurers that
only
basically
5% down.
5% down, sorry. But they basically make the difference between the 5 and the 20 that the banks actually want. And you finance that. You're able to lump that into your mortgage, increasing your mortgage amount. And it's, brokers like yourself that make sure the numbers still add up, even with that additional debt over and above the purchase price. But with rentals, not the case.
Right. So you can do 20% down, obviously minimum 20% down. Yeah. And then, so it's just, I find people that want to get into it sooner, that sometimes the way that they start, if it's going to be their first house,
the owner
occupied one. I see that one a lot. Mm-hmm. I mean, other than that, it's more like just making sure you can get like your financing, right? So your down payment, obviously your application needs to be strong enough for the banks to want to like finance rentals. So I find generally if you start, it's going to be personal. You're going to buy it under your personal name.
First step, yeah.
For the first few, for usually, generally, that's how it works. And then as you buy more, sometimes the ratios get harder for it to work. Because it's different now, but all the banks used to only use 50% of your rental income versus 100% of like the expenses.
Exactly. So 100% of your costs, but they only
Half of the
considered
rents.
your building 50% rented
in the ratios.
For the ratios. Yeah.
In like our application, right? So, and that's just like their safety net. But as you have more and more, it ups your ratios, which was like so now it changed a lot of like our lenders that we deal with. They're all different in how they calculate it, which is where if someone comes to see me, I can know which one would be better depending on how it's structured, how long you've had it. Did you make renovations last year and it's not on your T1 generals, or is it on your T1 generals? Like depending on how you have it set up, if you already own some, that's kind of where I can tell you which bank, or if you want to buy a new one, but which bank it's going to work with, because sometimes some of them have like worksheets where they're going to put numbers in, and it's not the same as 50% of the rental. It's not the same calculation, so it's sometimes better one way versus the other. So that's really where like we come in to help figure out. You don't have to be the expert. That's another thing. Sometimes people, they try to do all their calculations like on their own, like with whatever, and it's like, no, like just give me the numbers.
Give me the numbers. Tell me what you're buying.
Tell me
how
what you
much
want,
the rent is,
what you're looking for. I'll tell you what I need.
But owner occupied is like good point on the owner occupied, because not only are you buying a larger asset because you're buying a triplex as opposed to a single dwelling home, so usually more costly up front, but if that asset grows at 2, 3, 4, 5% a year, that's 2, 3, 4, 5% on a bigger amount, $1 million versus $500,000. But also the rent, right? So the rent does help you with your debt servicing ratios. So as much as not all of it goes in, particularly not in these smaller projects, but it goes and tops off, if you will, what you're able to support on your own. So,
right. And then you can also buy your house after and keep the rental, and still buy if you wanted 5% down with your like house.
Absolutely.
So doing it that way.
And also, the main thing with real estate in general, it's all about leverage. You work in a world of leverage, and leverage basically just means borrowing against something, using debt to get more and to get ahead with a certain project or investment, etc. It makes it a little more risky by definition, because the debt could still be outstanding if the project falls apart, and you're kind of on the hook for that. You personally sign on for that, but it also lets you amplify the scale at which you can operate. So equity is, so like you mentioned, you can buy an owner occupied, get away with the smaller down payment, have the rent improve your ratios, buy a little bit more house that you could have on your own. And then ideally you pay off your mortgage, the value goes up, you have equity, and guess what? Either that's your 5% on your dream home, or vice versa, it's your 20% on your next duplex, triplex, or fourplex.
Exactly.
And that is, we both know it. It's not easy, but that's how people get started in real estate, is building equity as early as possible, tapping into that equity and reinvesting it into the next project, the next property, and people snowball that into portfolios that become pretty substantial, right?
Yeah. No, that's totally how people do it usually.
Yeah.
If you're doing it from scratch and you don't have like partners that are already in it, or like
pockets.
Money, so it's basically the way that people do it, and that's how you build your equity. And I find it's almost like when you're paying down your mortgage, you kind of forget about it, because you only get like a mortgage statement maybe once a year in the mail, if you get it in the mail. So you kind of like forget about like you're actually paying down on your mortgage, your house is worth this much. Like it's almost like like forced savings account
Yeah.
that you can't always tap into the whole amount, right? But
Mhm.
it's still something that's there for you if you need it.
Yeah.
Either if you want to buy a rental, do you know what I mean? Like
Yeah.
more investments, or even like
Totally.
max out your TFSAs. Like you can do whatever,
Yeah,
right? There's
absolutely.
a lot of things you can do sometimes strategic wise.
Yeah.
Talking to the right professionals about it, and it's like, okay, yeah, I see, it makes sense. Like, and then you're like, yeah, let's do it. But yeah, no. So it's definitely something I feel people underestimate.
Yeah.
It's
Totally.
like, or like paying by like accelerated biweekly, or like paying down quicker.
Yeah.
Then you're building it up quicker. Like it's just all things that you kind of forget about in your daily life.
Yeah, totally.
Uh-huh.
One thing before I let you go here, I did want to bring up something. I mentioned it earlier when we sat down here. But one thing that often gets overlooked as a great way to get started in real estate, notably if the down payment is an issue. Not having, if you don't have a group RSP at work that's been chipping away and accumulating for you, if you don't have like RSPs or savings or access to capital to demonstrate or actually have your closing costs and down payment, there's such a thing called gifted equity. Is that still a thing in the industry? Yeah.
It
Okay.
is, yeah.
Could
We
you
forget that one?
Can you talk us through what gifted equity is and what are the what are the limits? What are the limits of what it can do and can't do?
Cool. Okay, yeah, we forget that one.
It's a good shortcut.
It's a good one. So, gifted equity is generally most lenders. It's if you're buying a house within family. So, usually it's like parents, grandparents, brother, sister. Like that's very much the limit.
Immediate family.
Immediate family.
Yeah.
But if let's say you're buying your grandparents' house or your parents' house, and they're selling it to you for less than what they could sell it on the market for, you can use the difference from like the value, like actual appraisal value.
The market value.
Market value, and whatever they're selling you for, like the purchase price, you can use that as your down payment. So you actually don't need to, like, there's no money exchange there.
Yeah, it's
they're
a
gonna ask an
gift.
appraisal.
They're just selling it to you
Gift.
slower,
Yeah.
like at a lower
The
price.
same as if they had the money, gave it to you for your down payment.
It's just upfront. It's
Yeah.
kind of like a reverse order of that. And so, okay, immediate family. Most lenders are okay with this.
Yeah, a lot of them do it.
A lot of them do it. Okay, again, your job to know which ones.
Yeah, it's simple.
Now, the last thing we'll touch on that is the nice thing about gifted equity is often if you're buying your parents' home or whatever, a home from somebody who might not need all the money that's coming to them from the sale, maybe it can be more than 5%. And what would be the advantages of having more of a 10 or 15? Because the fee from the insurer, the CMHCs and whatever of the world, so a higher down payment, lower that cost, right?
Yeah. So if you're putting, so with the 5%, it's 4.20%
of the total
of your total
purchase.
Mortgage after your down payment. So it's all like
4.2.
So 4.2 is
Tacked
added
on
to your
top.
mortgage. So basically, you're putting 5% down, and then you almost have another 5. It's coming
You're
back.
Financing another
If
5%.
you're financing, it's like your total mortgage finance is going to be close to like your purchase price almost.
Yeah, that's
like,
right. Your total amount
close.
financed going to be close. Right?
Yeah, because
Okay.
you're putting down 5%, then you add another 4.2 on like
To
the
the
net.
mortgage.
Yeah, so it's pretty close though.
Yeah.
And then if you do like 10%, then it's a bit lower. I think it's like 3 point. Is it 3?
Yeah.
It's not that much. 3.8, I think.
Yeah.
And then 15 is a little bit lower. It's
Better.
not like a huge difference.
Yeah.
But if you do 20% down, then you can do 0.
You avoid the whole fee.
You avoid it. The rates or the product changes, so sometimes the rates are different.
Oh yeah, okay.
And it's kind of they're always like, what? So when you put 20% down, a lot of the banks, it's an uninsured mortgage, conventional mortgage, and the rate's a bit higher, which doesn't make sense because you're like, I put like 20% down. What do you mean it's more? So sometimes that happens at the 20% mark. If you put more than that, there's like, it's like a sliding scale for rates.
Okay.
But then there's all different options. You can still insure your purchase even if you're putting 20% down or more. It's just you're going to pay a lot less, like point
Yeah,
whatever,
yeah.
like
Okay.
1%. I don't know how
So you
much
can
it
still
depends.
layer the
You can
insurance on
still
it.
do it, and sometimes it's worth it if there's a big spread on the rate.
Yeah.
If you're gonna get a much better rate, so that's all things that we
Yeah,
we
you
tell
can look
you.
at.
Yeah.
Okay.
Yeah.
Awesome.
Yeah.
Well, thanks for sharing that. And honestly, thanks for sharing all your knowledge. This was an awesome episode. I think a lot of people are going to learn a lot from this. So thank you very much for your time. And yeah, so if you
Awesome.
guys need any, obviously, if you guys need any debt or you need debt,
You don't
you guys
need
want
debt.
some more debt?
Have
Anybody?
enough debt.
More debt? No. But if you need some financing, purchasing your first home, for sure, go see your neighborhood mortgage broker. Centum does an excellent job. And if you need any help with getting ready for it, budgeting, any other personal finance tools, I'd be happy to help out. Visit my Plan Your Finances Project Online Academy, or reach out if you have any questions. All right. Well, thank you very much.
Thank
Have a
you
good
so
one.
much.
Okay. Bye.
Bye.